Can you guys, if you have audio, can you give some feedback? You got two people. Audio is good. Okay, we got Silvio and Mitch. All right, let's see if anyone. Let's wait another minute or so. So yeah, what I think I've seen Silvio. I think I've seen you chat in the group before. Um, I'm not sure about you, Mitch, but where are you guys at as far as the Forex market in general and the wedge alerts? You guys can either type or turn on your mic. French. I speak French. No, J Monty. But that's cool. You can type. Oh, MB. Yo, what up, MB? Okay. Yeah, Silvio J Monty. I cannot speak French. Um, yeah, as far as you guys, you're a beginner in the wedges. Are you guys able to draw the wedges and spot them? I know MB. I've seen you post some charts up. What about Silvio? I'm just trading low time frame. I'm just to trading low time frame. I think trade about 20 trade with wedge alert. Silvio, how long have you been trading the wedge alert for? A month? A week? You took 20 trades? How long did it take you to take 20 trades? One to 2 weeks. Okay. New to trading low time frame. Oh, okay. So Mitch, yeah, I seen a lot of your charts. You're posting on the daily hour and 4 hour wedges and stuff like that. Okay. So are you coming from a swing trading background, MB? Oh, okay. So more like okay. So more like position trading. Yeah, long-term trend trading. Okay. Um cool. Well, with that, um I guess I'll know where to go in because for me, I'm totally new to trading industry. I'm coming from marketing experience now. I'm focused on low time frame, 15-minute or intraday. Okay, perfect. Yeah. So for me, I also come from the um, I don't come from. I have experience in both the long-term trend trading and the intraday, but I prefer the daily movements, the intraday market, better. I learned to specialize in that rather. Um, and so when I was informed about the economy, I got very excited. I had already been trading about 4 years in the forex market, mentored by high level um, institutional traders and things like that. And so when I heard about the compass, I was actually in the process of developing some of my own strategy and what's it called? How do you EA or AI technology? I wanted to develop a lot of my technical analysis ideas and projections in the market into something to where I can use less time, because I was on the charts all day every day, and so I was really day trading, and I started a family, and so I was looking for a way to take my skills and put them into a system. But the thing is, I didn't want to spend the next 2 years learning how to code, and so I built connections, and I knew a few software developers, a few coders and stuff. I was really looking to program my thing. I even got connected up with a few private firms and investment banks, and they wanted to, pretty much buy my knowledge and stuff like that. And but I wouldn't I wanted ownership. I didn't want it to be taken away. So I was like, no, I'm good. But someone approached me about the economy, and I was like, oh, okay, someone's already doing it. So I don't have to spend resources or energy, you know what I'm saying? And so I was excited because, yeah, my strategies are good, but the Forex market it does the same thing over and over again. And so I didn't necessarily want something specific. I just wanted something that was going to free me up from staring at the charts all day, to where I can get a trend alert, I can get a breakout alert, and I can look at the market in a few seconds and actually know what's going on. And so I was excited about the EA that they had going. And then when I heard about the compass, I was like, ooh, that's even more so. So I started really getting into compass and stuff like that. And so I was already familiar with trend lines and breakouts and stuff like that. So I was really able to pick it up quick. I just didn't have to be on the charts to make my manual trades. I would just let the compass alerts hit. And then also I would check the charts, and I already know what's going on. So it was just something to free up time, so I don't have to watch for my own, you know what I'm saying? I only can watch 2 or 3 pairs at a time. So yeah, with the compass alerts, it is based off the 15-minute chart, and that's when you get the alerts come in, because you see this is 15-minute. And also got someone on. Okay, what's it called? Yeah, also too with the wedge alerts, when they come in, usually you're going to either see it immediately visually before you even start trying to plot an actual trend line, or it may not have played out just yet, because the software can probably spot the price action as it's going. So sometimes I'll get an alert and I won't see it, but I can see it starting to form. And sometimes it may take a few more candle bars for you to actually see the wedge. And so sometimes it depends. That's where you really have to have at least some understanding of the Forex market and how it moves in waves and the candlesticks and things like that. But yeah, the pretty much thing I can say is it shouldn't be too complicated. Like, if you cannot go on the chart and actually see the trend or the wedge, you probably should not be trying to trade, because that means the market is indecisive or in a range or going sideways. And those are usually not times to be trading in the middle of it. What you want to be looking for is it to be breaking out of the said range. So in essence, I'm just on a random pair, the Chief JPY, but I'm gonna go to a major in a second. But just based off of this chart right here, where the past 2 days, where is the market going? The answer, it's in a downtrend. It's pretty clear it's in a downtrend. So when I get a wedge alert, the first thing I'm looking is what kind of wedge alert is it spotting? Is it an ascending or a descending? When it's an ascending wedge, that means that the wedge is looking something like this. They're plotting it to look something like this: price moving up, and then it's anticipating a break to the downside. That's how they're that's the probability. Damn, my mouse is messing up. So with that, the descending is the opposite. The descending is looking something more like this on the charts. And then you're anticipating price to come up, and then break out to the upside. So when I'm looking for, when I get an alert for a descending wedge, when I hop on the charts, well, there's three things. The first thing I'm looking at is the general market direction. If it's unclear, I may want to wait for a more clear direction. Or I may need to analyze the actual range that it's in and wait for it to break out the range. But in essence, I'm looking at the general market direction. Has it been in an uptrend or a downtrend the past 1 or 2 days? So you're zooming out on the 15-minute chart and looking at, has it been in an uptrend or a downtrend in the past 1 or 2 days? And then you're looking at, say for instance, it's been on a downtrend in this example. It's been on a downtrend and you get a descending wedge. So when you get a descending wedge on a downtrend, that is going to be a counter break. So what that means is when you have a counter trend break, it's only going to go so far because you're trading against the trend. The breakout is against the trend. Now, when you're in an overall downtrend and you get an ascending wedge, that breakout will be in line with the trend. So it will be a more smoother trade opportunity. In essence, it will be a higher probability that you'll hit your target before you hit your your stop loss or it goes back on you. And so I'm going to plot an example that I see pretty clearly right about here. A descending wedge on the downtrend. It doesn't got to be perfect. It just has to meet at a point at some at some point on the chart. And sometimes they'll be a little bit bigger or sometimes they'll be a little bit smaller, but as long as it's on the 15-minute chart. So right now I'm not, it's a typical downtrend and we see a descending wedge forming. We have a breakout, but look at this breakout. It breaks out, goes up a little bit, and just continues down. So if you were going to trade this, you would really have to take your profits pretty quickly. So you can get about 9-10 pips if you really know when exactly to get out. In essence, you can sit here and scalp this, boom, get 5 pips and get out. And then when you're placing the stop loss, you don't want to place your stop loss until it's after it breaks out and confirms and goes in your direction. You're placing your stop loss. Sometimes you want to do at least 1-to-1 when it's a good entry point, but since the market conditions vary, you're going to want to place your stop loss below the nearest high or low. So that's a 13 pip stop loss. So in essence, this is not a good probability trade. You're risking 13 pips to gain, maybe 5 to 8 pips. And that's because you're trading against the trend. You should not expect to get much of a push. So when it comes to this type of scenario, this is the lower probability setup. I'm not looking to trade against the trend. You know what I'm saying? Especially, like, I would say, like, it's like I would want to look to trade if I don't see any other trade, but that's highly not going to be the case because there's always going to be opportunity in the market across multiple pairs, across multiple time zones. You know, you just gotta have patience. The next alert might come in a little bit, and then what will happen is the alert that's going to come in, it'll come in a few hours later, and it will probably spot this ascending wedge right here. You'll get an ascending wedge that's going along with the trend. Okay, so boom. Say the market plots this ascending wedge. This is perfect. You know it's in a downtrend, okay, overall, and it's giving you an ascending wedge. And so when you get an ascending wedge, you're anticipating a breakout to the downside. And so I'm going to zoom in just so you can see a little bit more clearly. So say we get this wedge and the market is about here, okay? You may have to wait 15, 30 minutes, 45 minutes. It breaks out and closes. Boom. Now you're in the races. The next step is the actual entry. So usually, if you guys have noticed, when the market has this any type of breakout and the candle closes above that support resistance or outside of that trend line, it's usually good to continue. Sometimes it'll close and this candle will drop straight in that direction. Sometimes it won't. It'll go a little bit like this, like it does here. But in essence, the way I set this trade up is once I see the market close with the candle, as it breaks, I'm entering the trade at the market at the opening of the next candle. So pretty much once I see it close, boom, I'm entering immediately. And that's because sometimes you can be able to see how fast the market's moving, and sometimes you won't. But these sometimes the break, yeah, like I said, it's mainly because these breakouts can happen, within 15, 20 minutes or not. But I'm entering at market price at the candle open. Boom. I'm placing my stop loss above these highs. So that's 12 pips. So for me, since I know I'm trading with the trend direction, I know I can get at least 1-to-1. So if my stop loss is going to be 12 pips, okay, I'm going to look for a 12 pip profit level. Okay, 12 pip profit level. It goes about 3-4 hours, maybe 5 hours. Boom, it takes you out over here. So you had to have a little patience with this one, but you hit your target, and you did it preferably before the next day opens, which is here, to where you don't want to hold these trades over into the day, because then the broker's going to charge you swap. So when you're trading these are scalps. So when you're trading this and say you don't hit your target, take whatever profit that you have and don't hold the trade, especially if they're scalps. There are certain conditions where you want to hold, but that's when I'm going to get into here next. So boom, you hit a 1-to-1. You just had to have a little patience. With this type of setup, when you're trading with the trend, you don't necessarily got to sit here and watch it. Once it breaks with the trend, boom, you set your stuff and let it go. And check it within 3 hours or so. It should be closed. If not, check it, every other hour to see if it closed out, especially if it's getting closer to the end of the market day. Now, this is a pretty easy setup for me to increase my chances and decrease my risk. What I will do is, for a higher probability setup, I will actually wait until the market pulls back first before no. I'll wait till it pulls back as well. So in essence, I'm taking about 2 positions. I'm entering as soon as the market breaks, and then I'm anticipating, or I'm setting a limit order for the market to come back and retest the trend line, which most of the time when there's a breakout of a support and resistance, or there's a breakout of a trend, it's breaking out and then coming back to retest and then continuing, especially when it's in the trend direction. So as you can see, the market came back that very next candle and touched the trend line. I would have made another entry about here. And Silvio, this is recording, but if you want to do your own recording, you can as well. But this is, you know what I'm saying, educational. This is not investment advice for educational purposes. That's a disclaimer for, you know, those who will be watching, and the recording of this. This is for educational purpose, not investment advice. But this is what I would have done. I would have entered another trade when the market retested. Boom. So now I have a better price to sell from. I have about 5 pips of a better price, and I have less risk. I can now risk about 7 to 8 pips. Okay. And I might even increase my, just because my risk is lower, I will do a 1 to 2 risk reward. So I'll risk 8 and I'll shoot for 16 now. So 16, boom. I'm out about at the same price. I just got more pips out of it because I got in at a better price. I waited for the retest. So in essence, I'm getting the 16 pips plus the 12. Okay? That's 28 pips. I mean, check the math, minus spread. Boom, I'm done for the day. I'm done for the day, guys. I don't need to trade another wedge. I don't need to trade another freaking, I don't need to look for 20. If you're getting 25, 30 pips a day, you're in the top 3% of traders. You know what I'm saying? Traders are not out here making 25 pips a day, or even a trade, if that, a week. 25 pips a week is a blessing for most traders. So when economy is giving out these wedge alerts to where you don't have to put in the work to capture these 25 pips a day, oh, you better appreciate that risk they're taking. Because for me, for me to watch this whole thing set up, I would have been having to look at the chart for a good 4 hours to catch this, or come back or whatever. But I don't got to do that. So so that's how I trade these wedges. Now, this is a pretty ideal setup. I'm not going to say you're going to get something this clear every time. So let's go over to, I like the Euro USD. One thing I do want to tell you is you might want to take notes on this. There's a, when you're trading different pair, the Forex market does the same thing over and over again, but every currency pair is different in the fact that it has its own market behavior in price. And there are many factors that have this happen. So in essence, when you're trading a major pair, you guys heard that term major, that's talking about the most popular or the most liquid currencies. The United States dollar and the euro dollar are the most like liquid currencies. That's pretty much, you know, a majority of the global economy moves in the US dollar or the euro dollar. So when you're dealing with something like that, it's going to be a less volatile pair. So the difference between liquidity and volatility is pretty much, when you have something like Euro or USD, it's not going to give you a lot of trending markets. Like it's not going to start a trend, boom, boom, and keep going for you know what I'm saying, 10-4, you know, 10, it's not going to keep going for 10 days. It's probably going to go back and forth because the euro dollar is just as strong, if not stronger, than the United States dollar. So it's almost like a fighting match that's like even. So in that essence, because they're so big, they don't give you a lot of pippage as much as other pairs that may not be so popular But because they're not so popular, that gives a little bit more of in essence, a fair game in a match. Like if you're in a fighting match, you have one guy that's freaking juiced up on steroids and you have one wimpy ass dude. That's an unfair fight. A fair, you know what I'm saying, an even fight is when you have the dudes who had the same freaking coach. They know each other's moves. So now they're not the fight's gonna go on and finish the rounds. What you want is a good pair that has a little bit of both. Not an exact match and not something that's completely unfair. So Euro USD is pretty much like an even match. There are pairs, and I'll put them in a scale of what I've come to know of where you get into the pairs that move a little bit and the pairs that move a lot. So in essence, what I'm trying to say is when you have a period of about 30 minutes or a period of a day, the Euro USD may have a daily range of about 40 pips. Like it may move up and down within a 40 pip range. On the other hand, when you get to a pound like the British pound, a pair like that, your average daily range is about 90 pips. Okay, so there's a lot more movement because there's a lot more volatility. So in essence, the wedge alerts, they do come in on the British pound USD sometimes a lot. So sometimes I'll just wait for those, and sometimes I'll take the more predictable ones. So for me, when I get a wedge alert on the Euro USD or the AU USD, I'm looking at something that's going to be a little bit more predictable, but a little bit less movement. So when I'm trading the AUD or the Euro USD, I'm only looking to capture between 5 and 10 pips. And I'm out. I'm not looking to really do a lot, but I do know it's more predictable than other pairs. So in essence, the slower moving pairs or the less volatile pairs are probably AU USD, the Euro USD, and then it's the USD Chief, and then I would say the USD Canadian dollar, and then I would say the British pound US dollar, and then gold. I think those are the pairs that the alerts come in. So in that order, I would determine the less volatile to the most volatile. So that's something I look at. Like if I'm looking to be a little bit more risky, I'll be looking to trade gold. I'll be looking to trade the British pound USD. I'll be looking to trade the United States CAD. That's if I want to take a little bit more risk, but I want to make a little bit more in pips. Now if I want to be a little bit, less risky and I just want to go for something that's not going to be too crazy, I'll go for USD, Euro, or Aussie. Because as far as when it comes to getting stopped out, these pairs are less likely to do crazy moves really fast. And they still do it, but when it comes to gold or the British pound, they'll sit there and take out your stop loss pretty quick. Like you won't even see it coming. So that's one thing that I do like. So I'm going to go in here to the AUUSD, and I see this on a downtrend for the past 2 days. Now, when the market has been trending 2 or 3 days, you may catch a few counter trend wedge alerts that will actually be a reversal. And I'm gonna show you. I see one right here, and I'm gonna try to keep this short because it might cut off soon. But I'm gonna show you the AUD USD. So we have a wedge coming in right here. And one more thing I would add is when you get the wedge alerts coming into your phone, one thing you want to pay attention to is what time of day is it? Okay, what time of day is the market in? Meaning, what current session are we in? So these boxes is a custom indicator that I have. This red box from here to here is the London Open to close session. This blue box is the New York banking session here to here. They overlap for a few hours. The green box is the Asian session. These overlap too. I just deleted some, but these overlap into the London session. So when you're trading the majors with a USD, when you get an alert, you want to stay out of the Asian session, which is the first 8 hours of the market open. But specifically on the AUD USD, it's actually pretty sufficient because the Asian market actually is overlapped with an Australian banking session. It's not as popular, but there is an Australian and a New Zealand banking session that is around the same time. So this pair could give you some opportunity as well during the first 8 hours of the market. In essence, besides that, when you're trading the USD pair, you want to wait for New York session and maybe London. I'm specifically a New York session. I'm on New York time. I get up in the morning. I start looking for alerts. I'm not paying attention to any other alerts at any other time because I don't need to take every opportunity. I'll take the opportunity that best suits me. So you take a look at what time zone you're in, when you're able to pay attention to the charts, and pay. So if you're only able to get online at a certain time, try to look for pairs that move during that time. So here we have a descending wedge during the New York and the London session right now. So we have a pretty good chance of some movement happening with volatility. A descending wedge on a downtrend. So this would be a counter break. So we have a large candle break about here. And this is one thing I said, I'm taking this trade immediately. Boom. And you see it doesn't come back. So I don't get that opportunity. If I was only gonna wait until my second entry, be like, oh, I'm only gonna take that trade because it's less risk. I'll miss the trade. So that's why I like splitting up my position anyway. So boom, I entered immediately, the candle closed, boom. This one actually came up for a total of about 14 pips. But like I said, this is AUD and the Euro USD. I'm going for 10. So boom, 10 pips. And sometimes it's not always exactly about pips. It's about what is the market telling you it's done? Where is the support and resistance? And that's where sometimes is most ideal to get out. The next support and resistance is right there. Boom. Market's going to have a reaction. So from here, boom, to here, that's 10 pips. So happens to be 10 pips. Sometimes it'll be, whatever. So I would even say if you was like, all right, here's a level of a support. That looks about right as well. So from here to here, boom, you got 7.5 pips. Cool, take it. It's a counter trend trade. We get further down the next day. We get another alert. During New York and London. From here to here, I'm plotting the wedge. Boom. From here to here. Or I want them to touch. So from here to here. So boom. This may actually be a nice trade because the market could be, it was going sideways this whole day. We get to New York, we have a breakout here. Boom, a small retrace. If you would have caught that, boom. But I'm going here. The next level of support or resistance is here. You guys can see that. That's a pretty strong level. We have 1, 2, 3, 4 touches. The market holds and breaks down. Okay, this is another form of a breakout. That is a wedge as well. But that's the next level of support of resistance, or resistance now. It was support and now turned into resistance. We get in here, our stop loss below here, about 8 pips. Target, 17 pips. Minus spread, probably 16. So we have a nice 1 to 2 risk reward. Boom. And if you're really trying to, you can take half your profits on, here's the next level of resistance right there from yesterday. And that's a good thing about the technical analysis you can leave on the chart. So from here to here, 16, here to here, that's 30, okay? Because this thing ran. So this is why I like paying attention to what time of day you are and being able to analyze the best condition to take a wedge breakout. You do not want to take a breakout when the market is not volatile, there's no volume, there's no liquidity. How do you determine your lot size? So you determine your lot size according to what you're willing to risk. So you determine your lot size after you plot out the trade that you want to get in. So if you see this breaking out, boom, first off, enter the trade. Boom. Then you look and you measure, okay, we have 8 pips. Where is a possible level to protect the trade. So boom, you measure 8 pips after you're in the trade. Now, or not even after you're in, even before, if you're trying to look for how much to take the position for, you might want to pre-calculate that. So I would say an essence of a stop loss, say about 5. Actually, no, forget the pips. You need to determine how much of your account you're going to risk. So say, hey, I want to risk 2% of my account per trade. Okay. In essence, you're looking to, okay, I'm willing to risk 5% of my account on a trade. Boom. Some people is even risky enough to go up to 7, 8, 9, 10% of their account. And usually people are more willing to risk more of their account when they have less to lose. So if you only got $100, $200 in your account, you know what I'm saying, 10% is $10, $20. So some people are okay, this money's in this account, so I can put it at risk. I'm comfortable with risking $10 to $20 per trade. Boom, if I lose, I lose. Now, if you got an account that's about $2,000 or $20,000, you may want to look at what 10 and 20% looks like. 10 and 20% is $100, $200, $300. And if you have a $20,000, that's $1,000. That's $2,000 you're risking if you're talking about some 10%. So it really depends on what account size you have and what you're willing to lose. You don't want to really be focused on the money except when it comes to what you're risking. You want to determine how much actual dollars are you willing to actually be at risk. Then after you determine that, then it's about the pippage, then it's about the percentage, then it's about what you're doing in the market. So in essence, if you're thinking, like someone chatted, you change your percent per trade or keep it the same. Usually it depends. For day trading, I change it either daily or weekly, depending. But if you're also on a trading plan, sometimes you'll set yourself a monthly target. I like setting weekly targets to challenge myself. So I'll say, hey, I want to hit 10% this week profit. I want to hit 20% this week profit. Or I'm like, all right, I'm gonna be a little bit more conservative. I want to hit 10% this month profit. I want to hit 20% this month. Like I said, if you're hitting 2% in a month, you're in the top 10% of traders, just because 90% of people are losing. So anyways, these numbers are not typical. So for me, if I'm saying I want to hit 20% this month on my manual trades, I can divide that by 4. So 5% a week is all I need for my manual trades. And if I want to take one trade a day, boom, that's 1% a day. When you divide it down, if you're like, boom, I can take a trade a day, or you sit there and just take 1 or 2 trades in that week and pick the very best setups. So boom, I'm gonna make this 5% this week on these 2 trades. That's 2.5% per trade. Boom. So it depends. Like when you get into percent, you're really doing some math, and you're really you're becoming disciplined with how you go about it. So boom, let's go with, hey, I want to earn 20% in this month off of my manual trades. Boom. So this week, I'm trying to catch 5%. So in essence, boom, I want to get 5 trades of the wedge alerts, or I just want to hit 1 or 2 good ones. So say this right here is going to be your 1 or 2 good ones. So out of the 5% this week, you see this setup and you're like, boom, I'm willing to risk 3% of my equity. So that's a 1-to-1. Now, if you see a setup that gives you a 1-to-2 risk reward, you end up making 6% now. You end up making more, you end up meeting your goal. So boom, 3% of your account. So say you have, let's just go with the even number. Say you have $1,000. 3% of $1,000 is what? 30. So you're willing to risk 30, all right, on a typical 1-to-1 ratio. And that's how I do it. When you're on a typical thing, you're going based off of 1-to-1 risk reward. Anything over that is in the plus for you. But you're going to account to lose money on a 1-to-1 risk to reward. That's how I would go about it. This is not for everyone. Personally, if you see me trading, you know I'm risking way more than that. Just because I'm focused on my entry price, minimizing my risk, and so I'll take bigger lot sizes. But anyways, to have a consistent game plan until you get your style, your comfortability, you start from the basics right there. So boom, I'm willing to risk $30 on this trade. I'm willing to gain $30 on a risk to reward 1-to-1. So in essence, you're looking at, okay, this trade here is now 8 pips. That's what we were able to plot out. From the close of this candle, you got, let's just say 1 pip below. That's 9 pips. Okay, 1 pip below the lows, 9 pips. Okay, so what is 30 divided by 9? In essence, let me put it this way. To make $30 in about 10 pips, okay, you need to be earning $3 per pip. 3, 6, 9, 12, 15, 18, 21, 24, 27, 30. Boom. Okay, so so that's a 0.30. Okay, to earn 10 pips. Okay, when you got, and you can just round it out. You can say boom. You could say yeah, on a 10 pip. So 9 pips, 9 to 10 pips is your risk. Okay. To risk $30, you would be placing a 0.30 on your $1,000 account. Okay. Risking $30, trading a 0.3 lot size, that would make you at 3% risk. Okay. This is, this is more along the side of aggressive. This is not conservative. This is, you're scalping. So this is a pretty typical risk amount. So $30, 3%, 0.3 lot size on this trade. Your 1-to-1 is 10 pips. Okay, because you're accounting for spread as well. So 10 pips, 9 pip stop, $30, 0.3. That's how you get, or Michael Cueva was saying 0.33. You want to get, all genius. You can scale it down and be exact. I just like rounding it up or whatever, because you have to account for spread as well. So sometimes I will be specific. Now, Essence, like I said, this was a pretty nice breakout. So say in essence, you end up holding this trade and you get up here to 16, where you get up here to 30. 30 times 0.3 is, what is that? That's 90. That's $90. You just made 9%. You know what I'm saying? But in essence, say you're just typical 1 to 2. Boom, you get out in 20 pips about here. You made 6%. You risked 3, made 6, made $60, and You know, you never got anywhere close to your stop loss. But like I said, a breakout this clean is not always happening. And it's hard really to anticipate when it's going to be a good one, besides if you actually know what the market's doing. The main way I'm able to determine, Michael said, I've heard most wedges are looking for 3 to 10 pips depending on price action. Yeah, so that's what I was just explaining. I was explaining when you're trading a low volatile pair like AUD or Euro USD, don't expect some pippage because those are very liquid and low volatility pairs. And so I'm not even trading the AUD USD during London. I'm waiting for New York and the US dollar to come in, or I'm looking for a trade during the Asian/Australian market. When, I don't know if you guys know, but there is an Australian banking session. So to trade the AUD would be good during the first 8 hours of the market open and, you know, the New York session. And so with that being said, you want to be able to get in and get out. And like I said, if you can sit there and hit 2 of these in a week, boom. Say you just 10 pips. Boom. The next day, another 10 pips. You hit 20 pips that week. Like I said, ridiculous results. What are those times for New York and Asian session? So for New York session, that's about 8 a.m. to about 3 p.m. Eastern time. For the Asian session market in Eastern time, you are looking at 5 p.m. Eastern to about 11 p.m. Eastern. You know, that's what I would be looking for. I'm not saying those are the exact times, but those are the times that I'm looking at those sessions to be trading, because I have it marked in my box. I only give this a 5-hour window. For the Asian session overlaps all the way into London here, but I cut it off because I've seen that most of the action is happening in the first 5 hours of the Australian and Asian market. And then after the move happens, it will consolidate for a little bit until the next session. So boom, breakout, consolidation, picks up in New York. Boom, breakout, consolidation, picks up in London. So when you're trading the AUD or the USD or the British pound or the Canadian dollar or the Japanese yen, I forgot about that one, you want to pay attention to what time of day it is, what session it is. If you don't have an indicator that you can see what session it is, ask me for it, or look at, or if you're using your computer, try to find one, because it's very helpful to be visual. And then, or if you're just precise on having a trading journal and you can just document, it's this time, it's that. Like if you can do that, you're good to go. But those are the main things that you pay attention to when it comes to volatility. What time of day it is will tell you how much potential you have. So in that sense, I don't usually do something like 3 to 5 pips because mine is spread. And if you're using LCMFX, the spread is at least 2 pips. So like, you know what I'm saying? I'm going for something that's going to give me pips outside of my spread as well, in commission. So typically, I'm doing at least 10 pips. When it gets low volatility, like the AUD, I may actually just go for 5, 6, 7 pips when it's not so good of a setup. Because sometimes AUD will only give you that safely. And so that's one thing I really focus on. I don't use indicators. You see an indicator at the bottom talking about a CCI, overbought, oversold. I do look at that sometimes, but that doesn't tell me any more information than what I'm already seeing on the charts, because I understand the candlesticks. That's going to have to be a whole nother session to really show you how I'm able to get in based off the candlestick action, which will also give you better entries. Like for this wedge here, I would have been in way before the breakout. The breakout happens here. I would have been in here just based off of this candle bar inside this wedge. So there's, when it gets into that, you really you can do some damage. This same pattern that happened here, boom, this candle right here, if you can take note of exactly what this looks like, this is a nice, strong reversal candlestick pattern. It's telling you right now the market is currently slowing down its position and wanting to turn in the other direction. But the buyers and sellers are still indecisive and have not cleared all the orders exchanging hands. So you see the pin bar, the wick. I don't look at these when they're in the middle of a sideways movement. This same exact candlestick shape is an inverted hammer. It's in the middle of some sideways movement. When it's a reversal pattern, it's after 2, 3, 4 strong bearish or bullish candles, and then it forms. Boom. 1, 2, 3, boom. And that's what I'm looking for as far as the candlesticks. But anyways, that's another thing, right? I use it, the price action, to tell me information of what's happening. I don't need the indicator at the bottom to tell me if it's oversold or overbought. This candlestick shape right here tells me exactly if it's overbought or oversold, quote unquote. Money's changing hands. But that's also an indicator of you know what to anticipate the market doing next. So time of day, and then when you're knowing that you're in the bottom or the top of a trend, you can expect a trend reversal. So this market downtrend, if we zoom out, we actually have a good 1, 2, 3 days of solid downtrend movement. Okay, so we have 1, 2, 3. Usually we have about 4 waves before a reversal. 1, 2, 3, 4. And what do you know? On the 4th wave, we're looking at a reversal. 1, 2, 3, 4. And the market looks like it's reversing come market open, about to be a bullish trend. That's the 4th wave ending right here, head and shoulders. So that's another key thing. When you zoom out and you look on the charts, the market moves in waves. So if it's on the 3rd wave, start anticipating stronger patterns to reverse. On the 4th wave, you better believe it's going to be 4 or 4.5 waves and before the market is turning. So you're looking for the lows or highs to be tested. This is the 4th wave right here. Boom. We have a low. The low was tested, and this, if you have a wedge alert at the end of one of these 4th waves, you're looking for a reversal. And then that's when you get into swing trading and stuff like that. But I'm looking to close this trade before the market close. So in essence, if I see a breakout like this happening, I'll sit there and put my stop loss to break even after it goes in my favor 15, 20 pips, and I'll ride it all the way into New York, and I'll hit that 30 pips. But that's only under certain market conditions, being where you're at in the market, what time of day, what wave are you in? Are you in a counter trend breakout, or are you trading with the trend? And what are the candlesticks saying? So that's what I'm looking at. So that's one of the reasons I don't need indicators. And these vertical lines here, this is also another plot that I drew on. It's just telling me what time of day it is. Between this time and this time, and between this time and this time, those are like my kill zone entry times. I'm only looking for wedges around these times. This is the beginning of New York. This is when I'm waking up in the morning at the beginning of, New York. This is the beginning of London. And as you can see on the AUD, there's not very many setups happening on the beginning of London. I mean, maybe we have an ascending wedge about here. That actually looks pretty nice. Getting me in right before London. Boom. We have a break. Close. The market takes off 30 pips. So these vertical lines are actually telling me what time of day it is. So I'm looking at the time of day, what session it is. You know what I'm saying? Like, so those are my things. I've seen Susan's formula fusion. You know, it's great, but you know what I'm saying? Everyone has their own style. She does do the RSI. When I'm using an oscillator, I do prefer the CCI, a little bit better than the RSI. Moving averages, I don't need moving averages to tell me what direction the market's going. I can see clearly just by zooming out. Um, and then I have a good understanding of candlesticks. But for those of you in the trading group, you have access to my knowledge. Ask questions. When I'm posting a screenshot, when you want to know what's going on, you post a screenshot and you share it. Okay, hey, what is this looking like? Boom, and then we can get some more discussion going in there. I'm definitely open to explaining to you the actual price action and the underlying story of what's happening in the market. And I'll even tell you straight up, hey, it's not a good probability right now. It's freaking 5 in the afternoon. You know what I'm saying? You should not be trading the British pound at 5 o'clock in freaking Eastern, because it's probably going sideways. So I'll be straight up when you guys are inquiring and asking what's this. That's what the group is for, and things like that. And so when you guys have questions, don't be afraid. Someone else could be thinking the exact same thing, so please ask it. And so I think that's gonna be it, unless you guys have any more questions. I don't know who's still on right now. Who's in the chat? What's Tyler talking about? What questions do you guys have? As far as I did talk a lot. When's the next webinar? What's today? Sunday? Okay. Let's get a fresh one. Let's get a fresh one at 9 p.m. Eastern then. 9 p.m. Eastern, right? Smack dab in the middle of Asian session. Let's take a look at this AUD tonight. It looks like it's going to be on an uptrend. Let's take a look at it. And don't even get me started on Fibonacci, guys. I gotta save that one. Don't even get me started on Fibonacci. Don't even do it. Michael, tell him right now, bro. Tell him don't even do it. Don't even get the Fibonacci going.
Yeah, yeah. You don't want to know how precise this guy can get with the Fibonacci. It's game over when the Fibonacci comes out for sure. But yeah, no, I was thinking getting these webinars done, like building up momentum, kind of ending the fourth quarter, because for those that have the economy app, or not the app, but that have the subscription, obviously the app is going to launch here very, very soon, and it's going to give access to pretty much everybody around the world. It's going to be free. And so I don't know if you guys know this, but essentially you can refer people out, and you'll be able to get a handful of those people opting in for the free app. And so when they eventually do want to upgrade and want to utilize the technologies that we do have, they'll be then, kind of utilized in your organization, and so on and so forth. But yeah, I'm excited. Henry, you're fucking stud. Excuse my language. But yeah, let's keep it like the next couple weeks at least, for sure. Then we can kind of do it like more like on like a steady schedule. Specific times of the day. I mean, we're basically all going to be traders, for sure. And we'll be rocking and rolling.
Yes, sir. Let him know, bro. Hey, but hey, that 777 fib level, bro, is too fire. Look at this wedge. I just I just plotted the wedge, bro, and it comes right in.
It's right
into there,
it's
bro.
Right there. Fib is in everything, bro. Right? It's in everything. We are.
For anyone who doesn't know, when I was talking about the market moves in waves, that's what Fibonacci is for. It specifically measures the wave conditions in the market. It'll tell you the probability of a wave pattern playing out a certain way, and usually when the market moves on its second and third waves, those are the best times to be trading in that direction because there you have the momentum. So right now, this is about to be the second wave if this is an uptrend. So if this breaks out, I'm looking to hold this at least 30 pips. Just because there's a low and there's a higher low, and we have a wedge on this Fibonacci. This Fibonacci is measuring this retracement of this bullish run. Okay, it's retraced about 70%, which is a high probability it's going to continue another 100% in that direction. Sometimes it'll come back about 50% of the way, which it came back about 50 here. It wasn't as strong, came back down. Okay. And so, so that's what Fibonacci, it's telling you where at in the current trend is the retracement happening. It's measuring the waves. So that's what Fibonacci is. I use that to integrate instead of my indicators that are just, on your MetaTrader. I like using vertical lines, horizontal lines, time of day, Fibonacci tool. You know what I'm saying? Like I'm a technical guy. I'm not really looking for an indicator that's telling me after the fact the information that I'm able to see live time. So that's how I look at these alerts. I'm taking an initial trade at the break and close, and then if it comes back and retouches, I'm taking a better trade with less risk and a continuation. And sometimes you'll see when this breaks out, you will actually get how do you say, when the market breaks out, you'll get an opportunity again. So if you miss the trade, don't try to get into it late after the wedge already happens. Like if you get an alert and you don't get to your phone in enough time to see it, look at the chart, it's already going, forget about it. Because if you take a trade and it's already going and say it does come back, you're now risking a lot more because it has to come all the way back, and then your stop loss is still going to be below the lows. So wait for the next wedge alert. And that's all I would have to say about this for today until the next recording. Sound good, market hackers? All right. Any other questions? Comfortability. You guys, markets closed. You can still go back and practice drawing the wedges, counting the waves, looking at what time of day certain wedges happen. Because if you go on the app, it tells you what time the alert came in on Telegram. You go look at that time on your phone to see when that alert came in, and then do the math, see what time it came in on the MetaTrader, and see how it played out at those specific times of day. That's how you practice. Another way is you wait for the live market on a demo account, and you do it that way. But yeah, that's it, you guys. We'll see you in the group. We'll see you in the Young Trep Market Hacker group, and we'll see you on the next webinar, the next charts. All right, 9 p.m. Eastern.